Hello, and we want to thank you for being on this call today with Monica Rebella, CPA and President of Rebella Accountancy, with a CPA firm that specializes in accounting, tax, and consulting services for hundreds of businesses and dentists in California. With the presidential election over and Prop 30 approved, outlook on what the federal and California taxes will be is beginning to solidify, and this is the topic of today's call with Monica, who will talk about these new taxes, the increases, and other rates that will be changed. And if we have time, we will open up the lines at the end of the call and take your questions for Monica. If you are not already a client of Rebella Accountancy or have not met her, Monica Rebella is a CPA, and she has 25 years of accounting and tax expertise, which includes 13 years of working with the Big Four, Big Eight firms, and over 12 years experience working with dental practices. She is president of the Orange County Long Beach chapter of the California Society for CPAs and is a member of the AICPA. She has also conducted training sessions for accounting firms as well as lectured on tax and business matters to the California Society of CPAs, UCLA Dental School, and the Orange County Dental Academy. And Monica runs her own firm in Tustin, California, providing accounting, tax, and consulting services for over 300 businesses through California, specializing in dental offices and small businesses. Monica, good evening and welcome to the call.
Thank you, Jeff. Thanks for that nice introduction. Well, everybody on the call, welcome. Thank you for taking your time this evening to listen to some of the things that are going on here now that the election's over. They are over, and basically we have the same people in charge. So what I want to cover tonight are some of the dramatic tax increases that we believe are going to happen in 2013 and some planning here that's imperative that we get done in 2012. So what's going to be impacted? Well, not only are the Bush administration 2001 tax cuts set to expire, but we do have the new Affordable Care Act Medicare surcharge taxes that come in January 1st, 2013, 3.8% surtax on investment income. This investment income is interest, dividends, capital gains, rents from rental property. So we have a lot of things that are going to be hit by that. And it can change and will change the effective rate. So people that are in the highest rate of 35% are effectively going to be going up another 3.8%. We also know that the long-term capital gains rates are planned to go from 15% to 20% with the Bush era tax deductions sunsetting. So we will go from 15 to 20%. And remember, we have these things called qualified dividends, or dividends you received from some of your stock investments, and they were recharacterized as capital. So they actually received a 15% bracket, and those will indeed no longer exist. Also, if Congress doesn't take charge of some things here, our estate taxes will go from 5.120 that we have right now, 5,120,000 as our individual exemption amount for not paying estate tax, to drop to $1 million and 55% rate on everything we own over $1 million beginning in 2013. So what I want to go over tonight are some strategies. You know, what are some of the strategies we want to think about here for 2012? But I want to start with this thing that you've probably been hearing about, is this financial cliff. We're going to go over the financial cliff, or we're not going to go over the financial cliff. What are some of the components in this? And then I want to give you some scenarios that have been running around in Washington, D.C. from from people that are out there espousing on these things. So the financial cliff, what's going on? Well, one is our debt ceiling is going to be addressed in January because we're looking at increasing our debt again. The Bush tax deductions are going to sunset, and we just talked about those, including the capital gains. We're going to look at our tax rates going up. With the Bush era deductions sunsetting, we go from a 10% tax rate at the bottom to 15. We all automatically will be losing our 10% tax rate, going to 15 immediately. The top tax rate right now is 35, and we're looking at bringing back 36.5 and 39.5. The alternative minimum tax will indeed go up if they do not act. We are also looking at the estate tax, as we said, going to $1 million with 55% rate on everything over $1 million. We're looking at a new excise tax on dental equipment and medical equipment come January 1st. So the equipment that you buy is going to be more expensive beginning January 1st. We're looking at the deduction we get for writing off equipment to go to $25,000 or maybe zero to write off in the first year beginning January 1st. So we certainly have a lot of different things that could be happening. So as I mentioned, people in D.C. have talked about different things about going over the cliff. They've got a few scenarios, and I'm going to give you kind of some of these things they've talked about. So one is, let's just do it. Let's just go over this financial cliff. Well, what does that mean? Well, it means that the parties just can't make a decision. They can't come to any consensus. And we just let the Bush-era deductions go away. We increase rates. Everyone pays more tax. Remember, there's these automatic decreases in defense spending and in some of the Medicare and other types of entitlements as well. So there's automatic decreases in spending. So, people see this as maybe a good advantage. The Democrats are looking at this as a strategic advantage. They let the tax rates lapse so everyone pays more taxes, and they can say, hey, we were trying to get things done. So, and the Republicans are saying, we don't want people that are in a lame duck session trying to renegotiate our tax laws when they're going to be on their way out the door. So, some people are saying maybe we go ahead and go over the financial cliff and just see what happens, and then it's going to be difficult for people, but not catastrophic. So that's one approach that people are looking at. The second is something called a big deal, a big grand bargain. Both sides have to give up something. So we look at a change in the rates, and people will pay more taxes. But on the other hand, entitlements will have to be tweaked. There will have to be some reduction in spending, and they'll have to figure out what that is. They're looking at the White House going from $250, per person or per married couple to maybe going up to $500 to $1 million, to where the tax rates are really going to go up for people. So there's a consensus there that potentially there's going to be a big deal. Both sides are going to come together and really kind of hash this thing out. Now, the problem with this is both have to come together and work this out before the end of the year. Is that likely? Well, that's a difficult thing to say at the moment because they both think they have good outlines, but they can't seem to come together. So the third thing that they think out of the five is something called a tax-free strategy. And what they're saying here is we take taxes off the board here for the end of the year. We address some of the other things that are not tax, so that we beat down this lift to going over the cliff with some of the other things that they can do. So they've got to deal with middle-class tax cuts. Well, that might be an item that they give up for the give and takes. And the Democrats are looking at a tax break for the payroll tax cuts. So, they're looking at the debt ceiling. They're looking at let's take taxes off and deal with those in 2013. So we will see what happens with that. The fourth one out of five is buy more time. This is the do nothing. Let's just kick it down the road, kick the can down the road for another year. And there's a lot of people in D.C. that see some benefits to this because there's such a short time frame. But President Obama is really not having much of this. He said, hey, we've been working at this for a long time. I think that we need to get something done. The White House is reporting, that, this is something that's been worked on for sure. And the Republicans are saying that we need tax cuts to spur job growth, but the Democrats don't see it happening. So what's also interesting is that we are finding that the credit rating agencies are warning that if they don't do anything, that they are likely to downgrade the United States debt and are out there again. So this would be a second downgrade in 2 years that they would do to the United States Treasury. So not a good approach here that the credit rating agencies are talking about. The fifth item is just to buy more time, but what is called with a down payment. So this would be a multi-stage strategy. When they're talking here is they're saying, all right, we want a few more months. So what we'll do is we'll have some spending cuts, and we're going to have to increase some revenue, but we're not going to do it all at one time. So the Democrats would have to say, okay, here's some spending cuts, and the Republicans would have to agree that taxes are going up. And they mostly likely, they're looking at closing some loopholes that they call loopholes, and we'd have to figure out what those are. So it'll be very neat that it's a short-term deal. It's to give a little more time, and both might have to give something up. So those are the 5 issues here running around about the financial cliff. Which one might happen? They're looking at maybe that last one. They give up a little bit and buy a little time. So that's the financial cliff. What are our plannings that we want to talk about around this? Well, one of the strategies that's being talked about here, and you probably have heard it, is gain harvesting. Gain harvesting is looking at taking your portfolio of assets, whether it's stock or whether it's real estate, whatever it might be, and saying, well, if I sell something now and pay the tax on it at these lower rates and then immediately buy back something, and this particularly works with stock, buy it back immediately. I've bought it back now at probably a higher rate because I might have had a low rate, and so therefore when I sell it I've got gains. So now I'm buying it at a higher rate, so if I sell it I might pay less tax even if it's at a higher rate. So that's kind of gain harvesting, right? Let's pay the lower taxes now and buy it at a higher rate and pay less tax, and that even though the rate might be higher. Now, it sounds simple, but there's an awful lot of different things you have to look at when you're looking at whether this is the right approach or not, because it can be quite complex. And we also still have a 0% capital gains bracket, but your income has to be quite low. So it's definitely one of those things that we have to plan for, and we have to go over it, because there are certain variables. Here's some of the things we have to look at. The time period between when you sell and when you now and pay the taxes and when you were going to sell it. Okay, there's a really important part to that. Then there is the difference between the tax rates between the two sales, the growth of the stock. You know, it could go up or down, right? We've seen a lot of up and down going on. And then the opportunity and loss of capital. So your return on investment, what does it make sense? It makes sense for people who were going to sell it in the next year or two. So the shorter the time frame between now and the higher tax rates, that's the best benefit. If you're a person that says, hey, I want to hold on to it until I die, an older person, and let my heirs have the step up, that's absolutely the wrong person to do this, because their strategy is to buy and hold and get the step up. So it really needs some planning, and there's more aspects to it than that. So we definitely want to look at that kind of thing. We're also looking at, as I mentioned, some higher Medicare surcharges, right? So beginning January 1st, 2013, we've got a 3.8% Medicare surcharge taxes on these investment items, capital gains, dividends, interest, rents from rental properties, royalties. Those kind of things are going to get hit with a 3.8% medical surcharge tax. And you're saying, well, wait, Monica, now I've heard about that, but people are saying it's only if you go over that 250 mark or 200 if you're single. And the answer is this. No. It's what the amount might be you pay the tax on. So you're going to pay the tax on the lesser of your investment income of those items, or how much you have gone over the 200,000 or the 250, whichever is lower, your investment income or how much you went over those thresholds, 200 if you're single or 250 if you're married. So keep that in mind. The other is that I found interesting is that there's also a 0.9% Medicare surcharge. Now this has been around because the combination of these is 4.3, but there's a 0.9% Medicare surcharge tax on the amount you go over the threshold. So there's a 0.9 Medicare surcharge tax if you go over $200,000 in total income for single, or $250,000 income if you're married. So when you put these together, you might be paying 4.3% additional tax for Medicare. That's what that comes to. Okay. So what does that mean? Well, normally at the end of every year, we think about prepaying expenses. Let's accelerate deductions in the end of the year. We want to bring down our revenue at the end of the year. Well, 2012 may not be the year to do that. We might want to think, and it takes careful planning, is this the year to pay lower taxes on income? And it needs careful planning, because if it's just a deferral for 1 year, if you're still making money and you're continuing on an upside, this would just be a one-time thing, because you're going to make more money next year. You're going to make more money the next year. So, how many years are we really getting here? We're getting a couple of months additional lower tax rates, but really your income's continuing to go up. And we've got to plan for that. We've got to make some calculations on that. So it's important that we take a look at these things. They can't be done in a vacuum. However, there are people still doing Roth conversions. Remember, we've got this thing out here called Roth IRAs. This is where you can put money into it and leave it in there, and it appreciates in value. And you take it out when you're 59 and a half or retired, and you never pay any tax again. It's after-tax dollars. We don't get a deduction for what's in there, but we never pay tax on the appreciation. Well, you can move your regular IRA money into a Roth IRA. Now, the catch is you're going to pay tax on all that IRA money that was a tax deduction right now, but then you never pay tax again. Well, 2012 got lower rates. So if you still want to do it, there's still time to do that. And you have all the way till October 2013 to reverse it. So if the market takes a big tumble, you can say, I didn't mean it, I'm reversing it. Okay? So there is that opportunity. But again, you will pay all your income tax on the amount for the regular IRA to go to the Roth IRA. But these are the lower rate years. If you do it in 2013, it will clearly bring your income up, and it will clearly put you into those Medicare surcharge taxes, those additional 0.9 and 3.8. So 2012 is the time to do it. And there's no set amount. You can do $1. You can do all of your IRA. You can do 10%. You can do 50%. So it's something to think about. It will bring your income up, but again, 2013, you would clearly get into those Medicare surcharge taxes. So we've got those. So we've dealt with those. So, and we've dealt with accelerating income in 2012. Definitely something we have to talk about. Now, one of the last things that I want to touch on, and there's just minor things beyond this, is estate tax. This is really crazy. And we're hoping they will actually address this before the end of the year because people need to plan. Right now we're at $5,120,000 per person in total assets, cash, investments, real estate per person that you can have when you pass away and not pay any estate tax. And if you go over that per person, it's 35% tax. Well, we're looking at January 1st, that being $1 million per person and 55% tax on everything over that $1 million. It doesn't seem that crazy to people that might live in Iowa. But it's crazy for those of us in California where $1 million, you've got a retirement plan, you've got your house, you might have some investments, you're well beyond $1 million a person. So it's really something we hope that they're looking at. They've been begged, they've been pleaded, so we will see where they go. What I've heard is that President Obama, before the election, was settling at 3.5, which is what the number we had for 2009, 3,500,000 a person. But he didn't really mention it during the election, didn't mention it after, and we haven't heard a whole lot about this since the election. So it's really one of these places that we're really struggling with. Where is this going to come out? Should we still gift? Yes, still gift away. People are going to pay tax if you have more than $10 million in assets together. So realize if you've got more than that, you should be gifting anyway. But it's always good to gift. Next year, 2013, the per person gifting amount goes to $15,000. So keep that in mind. This year it's $13,000. So one last item, and then we might open it up for questions, is remember, California, we passed Proposition 30, which was a tax change, not only in income taxes, but sales tax. Well, if you read Prop 30 carefully, the income tax portion is retroactive to January 1st, 2012. The income tax increases are retroactive for this year, 2012. Now, the good news is, unlike the federal law, where it's $200,000 if you're single, $250,000 if you're married, for the California law, it's $250,000 a person before the new tax increases are affecting you for Prop 30. So you would have to have $250,000 as an individual if total income before the new tax rates you're hit with the new California tax rates. And for a married couple, it'd be $500,000 of total income. So if you hit those thresholds, you will have a 1% increase in your California top rate. The California top rate is 9.3. You would go to 10.3. Okay? If your income is beyond that, so if you have gone up more than $300,000 single and more than $500,000 if you're married, you get a 2% increase. You go from 9.3 to 11.3. If you go over $600,000 as a single person and over $1 million, you will have a 3% increase. So you go from 9.3 top rate to 12.3. If you hit the $1 million mark, there is already a 2.5% increase in California taxes. So if you go over $1 million, you actually are looking at a 14.7% increase in taxes. So it's although the rate sounds small, it's really a huge increase in taxes in California if you meet those marks. But at least it's $250 a person, which is good news for us. So that's just to give you a little bit of where we are, some of the things that we have to really take account for here in 2012 before we hit 2013. I've got clients that are looking at selling their practices. And we've been talking over the last couple of months as to whether it makes sense in 2012 or 2013 if they're within a year or two. And it needs careful analysis. But if your practice isn't up for sale now, it's not going to sell by the end of the year. But it has taken a lot of calculations to figure out if it makes more sense this year or next year. So I hope that gave you a little bit of glimpse into where we are, what kind of things we have to think about and plan for, and there'll be more coming. But Jeff, I'm done with what I've got at the moment. We might want to open it up.
Sure, Monica. The lines are open, so if you do have a question for Monica right now, just go ahead and speak up.
Is there a way to get this information on email? Because it's hard to hear on the speakerphone.
We will put out a newsletter, so watch for the newsletter because it will have this in it as well, and it will come out in December.
Oh, okay. It was great that we're getting together with the teleconference.
Good.
Thanks so much.
Thank you.
Any other questions? The lines are open, so if you have a question, just go ahead and speak up.
Monica, what about purchasing a car before the end of the year? Any considerations there?
Good question. 2012, we still have two things that we enjoy about buying new assets, whether it's a car or equipment. We have a 50% bonus depreciation on buying new assets, and we have the Section 179, which we always enjoyed, which is writing off the assets in the first year when you buy them. So if you do buy a car before the end of the year, both of those potentially can come into play here. Now, I'll say this with a little bit of a caveat. Remember, if it's not over 6,000 pounds, if it's a car that's under 6,000 pounds, we're going to get some, but we're not going to get a tremendous amount because we're still limited to what the IRS calls luxury automobile requirements, which is they tell us how much every year we can get in depreciation. So in the first year we get 8,000, but we would actually get to kick it up to about 11,000 if you still buy the car around the end of the year. If you buy a car over 6,000 pounds, we are out from under these luxury automobile rules, and we actually could get a lot more. It depends on what the cost is, but we at least get the $25,000 for something over 6,000 pounds.
Thank you.
Sure.
Monica, were you going to address wash sales?
I couldn't hear that last part. Address which thing? Can't hear you. I think it's your cell phone. You're in a dead zone. Send me an email. Anybody else?
On the Roth IRA, Monica, what if we've already established a Roth IRA, what can we put in for 2012?
The Roth IRAs follow the regular IRA rules for the most part, so we'd be looking at $5,000 to $6,000 depending on whether you're over 50 or not. So they basically follow similar rules as to the IRAs. But I can look at it more specifically if you want to send me an email.
Okay, and these would be after-tax dollars going into the...
Correct. It is not a tax deduction.
Okay.
Monica, I see it. You covered a lot of good information, and it sounds like if people have questions, they can, email you or give you a call at the office?
Absolutely. This week I will be out. We had a death in our family, so I will be out this week. But if you want to send me an email or something, I will save them, and I will certainly get back to everybody.
If somebody's listening on the audio replay, Monica, is there any sense of urgency in terms of getting a hold of you before the year on some of this, or is it wait until after the first of the year?
No, as soon as possible. We need to make calculations to figure out some of these things as to what's going to happen this year. Are we going to harvest gains? Are we going to buy automobiles, et cetera? So definitely, as time is of the essence at this point. We are at the end of the year.
Okay, great. Well, we want to thank everybody for being on today's call with Monica Rebella, CPA. Monica, thanks again for this information, and we'll send the email newsletter with the audio replay so everybody can hear this, and if they have a question, they can give you a call and an email.
Yes, let me just give them the phone number and the email in case they don't have it. The phone number is 714-619-0667. The email is mrebella, Rebella, @RebellaCPA.com.
Great. Monica, thanks again for taking time to be on the call, and we want everybody for being on with us tonight.
Yes, thank you.
We'll talk to you soon.
Bye-bye.
Bye.
The conference is now completed. Goodbye.